What does freedom mean to you? Does it mean not requiring anyone's permission? Does it mean being listened to and trusted for being your unique self, for your unique needs? Or does it mean complete transparency? This is what decentralized finance or DeFi is bringing: freedom. The DeFi ecosystem is experiencing exponential growth, especially in the last couple of years. The locked value in DeFi increased by 17 times to 71.8 billion US dollars as of 3rd August 2021. At an all-time high on 12th May 2021, the total locked value in DeFi was at 89.6 billion US dollars. If you look into the segments, lending is the largest segment with a 47% share, followed by decentralized exchanges and asset management. Growth-wise, asset management and decentralized exchanges are the fastest growing segments. So what is driving this rapid growth? Let us start with the regulatory environment. Regulators have been behind the curve in DeFi, and now they have to strike a balance between the killing of a flourishing industry and risks associated with unregulated DeFi platforms. DeFi platforms, such as lending, offer an alternative to highly regulated banking sector. Regulators lately are also showing some support to the DeFi ecosystem. For example, the SEC approved an Ethereum-based fund, ARCA, in July 2020. ARCA issues shares as digital securities that are transferable using blockchain technology. Mainstream players are also showing support to the DeFi ecosystem, from major banks joining blockchain payment networks to Wall Street investors getting into Bitcoin. The crypto ecosystem is gaining acceptance from the mainstream investment community. COVID also accelerated the growth of DeFi ecosystem. COVID-induced low interest rate environment is stimulating the DeFi ecosystem. When the interest rates are record low, DeFi lending, which offers considerably higher interest rates, seems lucrative. All this talk about DeFi, but what is DeFi anyway? DeFi refers to blockchain-based systems that disintermediate financial markets. Let's simplify that. In the traditional financial system, various intermediaries such as banks, brokers, insurance companies, and security dealers do trust intermediation. That is, they establish trust between the market participants. Often, access to financial markets is controlled by these intermediaries, making the market access difficult and expensive for customers. Decentralized finance aims to remove the need for such intermediaries with trustless, permissionless, and automated systems designed on blockchain networks. Trustless, because DeFi systems do not require trust to function. Permissionless, because DeFi networks operate on public blockchains and anyone with crypto wallets can access the DeFi networks irrespective of their location. Automated, because various processes such as market making, are automated in the case of DeFi systems. So, how is DeFi different from traditional financial systems? To understand how DeFi systems are different from traditional financial systems, let us compare DeFi lending with traditional lending. For that, we need to go one step up and think in terms of the monetary system. In a fiat monetary system, the central bank decides the policy interest rates, and those rates then transmit through the credit system. The policy rates and money supply to the monetary system are decided based on various economic factors, including the stage of the economic cycle, inflation levels, and demand for credit, etc. These policy rates then transmit through the banking system, and depending on the efficiency of the credit system, the policy rates are reflected on the lending and deposit rates. The DeFi systems are protocols or set of rules on which various markets can be developed. These markets can act as lending systems or asset markets or security exchanges. The policy decisions for such markets, such as interest rates for lending marketplaces, are taken by algorithms based on rules set by the protocols. Structurally, compared to traditional financial applications which use core banking systems as the underlying ledger of records, DeFi apps use blockchains such as Ethereum, Solana, and Binance Chain as their underlying core ledger. The blockchain removes the requirement for account reconciliation systems and systems for settlement and clearing transactions. The DeFi systems are built as application layers on the top of a blockchain network and accessed through various front-ends, wallets, oracles, and block explorers, etc. Front-ends are applications built to interact with multiple DeFi projects at once. Some examples are Zapper.fi and Step Finance. Wallets are interfaces people use to store crypto assets and interface with DeFi apps. Some examples are MetaMask, MyEther Wallet, Coinbase Wallet, etc. Oracles are data feeds that provide outside information to the blockchain network or blockchain data to the outside world. The information provided by oracles is required by the blockchain and smart contracts to perform transactions. One example of oracle is Chainlink. Block explorers are used to querying the blockchain ledger itself directly. They are generally used to verify transactions. From an operational point of view, DeFi systems are different from traditional finance in many ways. For example, in the case of DeFi, the custody of assets are with the users themselves in a non-custodial account or via smart contracts, instead of custodial service providers. The execution of transactions of a DeFi network takes place by smart contracts, which are self-executing programs on a blockchain network. These smart contracts eliminate the need for intermediaries. One of the important differences between DeFi and traditional financial systems is auditability. As DeFi transactions take place on public blockchains, all transactions are traceable and auditable openly. The open infrastructure of the DeFi protocols means that the developers can build infinite types of customized financial products suited to the specific needs of various target customer bases. This is a complete departure from the traditional financial system where a few large firms decide the types of products based on their ability to earn profits rather than the customer needs. This means that DeFi has the potential to serve customer bases ignored or underserved by traditional financial services, such as small businesses, customers with lower ticket size, thin file customers, and customers who lack access to various documentation required by the traditional firms. So, we can see that from custody to transparency to governance, DeFi systems show potential of bringing freedom in the financial system. Freedom from jumping through hoops and dealing with various intermediaries to access financial services. Freedom of getting your own unique needs met without compromise or excessive cost. And freedom of complete transparency of cost and process. With this is Sam Ghosh. Bye bye.